Good morning. Welcome to America First Wealth Management Investment Outlook for Monday, February 3rd, 2025. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First. Thanks for tuning in. This is our standard disclaimer. This material is just for informational purposes. We're not offering to provide investment advice, recommend, or solicit to purchase or sell any securities or investment products. These opinions are solely ours as of February 3rd and subject to change as market conditions and data change. We like to begin with our market outlook and provide some additional supporting data and tables and charts. The important news for this week was obviously the Trump tariffs, which were announced and began effective February 1st on Saturday. An immediate 25% tariff on imports from Canada and Mexico, and 10% on imports from China. And why did the administration announce this? They wanted to address issues like illegal immigration and drug trafficking, and felt that these countries were not doing enough to stop those issues that were hurting the U.S. Canada, Mexico, and China immediately announced retaliatory tariffs. And because of this, the markets are reacting negatively. Futures are down significantly this morning. And there are concerns that this is going to trigger an economic slowdown and a rise in inflation. Turning to last week's important information, the FOMC maintained the Fed funds rate target at 4.25% to 4.5%. And the Fed's preferred inflation indicator, the PCE, last week edged up 2.6% for December from 2.4% in November. That was in line with expectations, but it also rose to the highest rate in 7 months, which can perhaps account for the FOMC's stance. They probably had a good look or insight as to what that number might be, having announced their pause in rates prior to the PCE number being released. Also happening last week and through the weekend, Trump's overhaul of federal government agencies is underway and happening quickly. At some point, we do expect the bond market to be cheering the reduction in spending, but right now, the rapid change is sending investors to the sidelines. We had been calling for a market correction for several weeks now, largely due to what we saw as obvious overvaluation in the S&P 500 PE ratio, and also a lack of market breadth. We had pointed out that the top 10 names in the S&P 500 were now accounting for 40% of total market capitalization weighting, and these extremes could not be sustained. And now it appears that we have a correction that may be underway now. Before we delve further, we wanted to say a few words about tariffs, because as I spoke to people late last week and over the weekend, I just felt that a lot of people just didn't understand how tariffs work. Many people responded by saying that, oh yeah, China, Mexico, and Canada, they'll have to pay the tariffs. Well, the truth is, it's usually the importer of the imported goods that pays the tariffs. So it's going to hurt the cash flow of importers of these goods if they have to pay the tariff amount before receiving the goods. However, large importers, because of their higher purchasing power, can demand concessions from the supplier. They can ask the supplier to pay some or all of the tariff, or simply ask them to reduce their prices. And if they don't, obviously the importer will reduce their purchases and demand will drop. So it's kind of a negotiation tactic, but the short-term impact is that importers who need these goods will be forced to pay those tariffs, and that these tariffs will immediately be passed on to the consumers or buyers of those products. So we have a short-term impact of rising prices. However, in the long run, if importers reduce their demand because of the tariffs, that can lead to deflationary impact. Uh, it lead to companies being forced to lay off people, slow down production, general economic slowdown and activity. And I just want to point out that the Smoot-Hawley Tariff Act of 1930 had raised U.S. tariffs significantly. It did lead to a global collapse in trade. Severe deflation was the long-term effect of that. Business failures, bank failures, high unemployment. And while it didn't cause the Great Depression, which actually began with the stock market crash of 1929, it did worsen and prolong the Great Depression. So the big question we have is whether or not Trump's tariffs are a short-term negotiating tactic, or will this lead to a long-term trade war? And the history of the Smith-Hawley Act, Tariff Act, obviously tells us that long-term impact of tariffs is not good. So hopefully we will see this being a short-term negotiating tactic by Trump, but we'll see. Initial reactions by countries by retaliating with tariffs of their own is not a positive one in our mind, but hopefully you'll force them to talk, get to the table, negotiate deals, and reach a point where all parties understand that tariffs are just not good globally for any economies or any nations. What is gold telling us? In the past 1 year period, gold is up about 40%. So gold is, in our mind, telling us that it's worried about something. And obviously, with the new administration and all the rapid actions and change in the federal government, uh, change is definitely not good. Markets do not like uncertainty. Gold has a long-term history of investors running to gold to shelter themselves from risk, potential inflation, overall uncertainty and market volatility. So the top horizontal line shows us that we are at a near-term resistance of about 2,800. And we can see when the last resistance level was crossed in the stern last year, we had a strong rise in gold. Let's see if this resistance holds or we break through. If we break through, gold, in our opinion, is going much higher. But if it settles down, then we do expect a sigh of relief by the markets and investors. But it's a very critical canary in a gold mine that we're watching carefully right now. A key piece of information we saw recently was JP Morgan. They are the world's largest bullion dealer. JP Morgan and other institutions declared plans last week to deliver bullion against futures contract traded on the CME COMEX that expire in February. And JP Morgan themselves said that they're going to deliver physical gold bullion worth over $4 billion versus futures contract in New York. And that's pretty significant. We haven't seen this amount of physical delivery being done since 1994. So just the fact that there is huge demand for physical delivery is something we need to watch carefully. And whether or not after these contracts settle, if gold continues to rise or fall, that'll clearly be a gating factor in the direction of risk taking, whether we have a risk off stance or a risk on stance. So we're going to watch to see how gold trades after settlement. Excuse me. Um, Similar to last week, we have a lot of macroeconomic data and S&P 500 earnings. Just to summarize the key macro events for the week, for today, Monday, we've got S&P Global Manufacturing PMI, ISM Manufacturing PMI, and construction spending. Consensus estimates are shown on the slide. Excuse me. Tuesday, we've got factory orders and JOLTS job openings number. Wednesday, we've got ADP employment report, S&P Global Services PMI, ISM Services PMI, and international trade balance. Thursday, we've got the initial jobless claims, Friday, non-farm payrolls, unemployment rate, and University of Michigan consumer sentiment. So lots of key macro data events for the week. We are predicting, once again, higher volatility for this week as well. Turning to key S&P 500 company earnings and revenue estimates for this week. Alphabet, PayPal, Pfizer, Walt Disney, Uber Technologies, and Amazon. I won't read through all the estimates. They're listed here. These are the key companies that we've picked out. There are many companies reporting this week. We count 131 of the S&P 500 companies reporting this week. So all these data points, obviously, will be creating a lot of trading volatility. Good for brokers, perhaps concerning for investors and traders. We'll be watching the action closely. Turning to the weekly market stats ending last week and also for the month ending January, as the weekend and the month end coincided on the same day. For the weekly action, you can see only the Dow, International Stock DIFA, and bonds were up slightly, no major movements there. However, for the majority of the equity indices, they were down. S&P was down 1%. The tech-led NASDAQ and NASDAQ 100 were down roughly 1.8 to 1.85%. Small caps were down 0.8%. Large growth was down significantly, 1.49%. Large value stocks weathered the downturn much better, down only 13 basis points. For the month and also the year to date, we do have all the indices positive. So last week's drawdown obviously is a little crimp in the strong start to the year. We're still net positive for the year, but let's see if we stay there as we get through the earnings season here and continued presidential executive orders and implementation of those policies. Excuse me. Turning to the Magnificent Seven names, NVIDIA took it on the chin last week, down 15.8%, largely due to the fallout from the revelation that the DeepSeek Chinese AI, generative AI program was able to create their machine learning model significantly cheaper and faster than other generative AI models. So the lower costs and faster time to implementation caused a panic and fear that demand for hardware for AI use is going to drop significantly because of enhanced software techniques. And a debate is still out whether or not that's truly going to happen, or it's going to only increase the demand for AI hardware, because this means that AI software will be much cheaper and drive larger demand. So that's the big question. Obviously, with the huge run up in NVIDIA, as you see, 2024 up 171%, and up 239% in 2023. Any potential question marks is likely to be treated as let's pause, take profits, and find an excuse to sell. And certainly being early in the year, this is probably a better time to sell and defer tax payments until later in the year. And we saw a big rush to the exits, especially for NVIDIA. NVIDIA doesn't report until late February, I believe February 26th. So we'll wait to see what NVIDIA says about how the DeepSeek news is going to potentially impact demand for their GPUs. But we do expect volatility in trading around the general market downturn, and the leaders that led in the last 2 years, namely Magnificent Seven, could be seeing some drawdown here. Meta and Apple were the shining stars for the week. Apple up about 6% and Meta up a little over 6% for the week. We're seeing some choppiness, and we do expect that to continue if broader indices also trade down. Turning to sector performance for the week, and also year to date, we are seeing a change in leadership. Let's turn to the year to date column. You can see tech is the worst performer of the sectors, down 74 basis points. The top performers have shifted to healthcare and financials and communication services. And healthcare also was one of the stronger sectors for the past week, second best performing sector. Communication services was the strongest, I believe, led by Meta. That's a big weighting in that sector. It'll be interesting to see if healthcare continues its lead as the confirmation hearings for RFK Jr. continue, and if he is affirmed as the HHS secretary, it'll be interesting to see if healthcare gains will sell off or it will continue. So expect some volatility in healthcare. Don't be misled by the recent gains. So that's we are just throwing out a little warning right there. But in general, we do feel that it has been a pretty good time to be diversified in cash and bonds, in addition to equities, and among equities to diversify away from technology. It's good to see some breadth emerging for some of the value sectors and for some of the sectors that were lagging for the last 2 years. This is the 1-year S&P 500 chart, still trending upwards, but as you can see, we have crossed the 10-day moving average, which has been a short-term signal for us. So we're kind of into a short-term bearish zone for the S&P 500. The RSI is looking like it's trending sideways to down here. So we're looking at some distribution pressure on the S&P 500 near term. Turning to the 10-year Treasury yields, ended at 4.58. I'm sorry, that should be 131.25, not 124. So we were down 5 basis points for the prior week. We are flat on interest rates since the beginning of the year, 4.58. The trend is down with the declining 10-day moving average and the rate coming down. 10-year Treasury yield. And 10-year Treasuries also tend to be a flight to safety trade when the markets sell off. It doesn't necessarily reflect inflation going higher or lower in the short term. It does reflect a flight to safety trade, in our opinion. So if equity markets continue to drop, we do continue to feel diversification into bonds would be a safety trade. Turning to the yield curve, um, the blue line is month end January, yellow is end of last year, and orange is the prior week. We do see a slight decline in the yield curve um, for the year end, and looks a little off here. The year end says 4.58 and the January end says 4.54, but we know it should have been 4.58. So we're just going to check those numbers. It should have been more coincident, right on the line versus the shift that we see here in the chart. So we'll just check the chart later. Sorry about that. Turning to the economic calendar, we already highlighted the key macroeconomic data points, so I won't dwell on these, but there's obviously quite a lot. There's two Fed governor speeches on Monday, Bostic and Muslim. That might give some insight as to the recent FOMC meeting and how Fed governors were viewing the potential direction of interest rates, inflation, and jobs data. This is Tuesday, and the JOLTS job openings will be the key number in the morning at 10 a.m. More Fed governors speak, Bostic and Jefferson, and also Daly. We have a number of Treasury auctions this week, some which are quite sizable. Hopefully they'll go off well. Volatility in the equity markets should help these auctions, but if investors are on the sidelines and these auctions are not met with strong demand, that could trigger some adverse interest rate action here. Wednesday, ISM Services PMI, 10 a.m. Lots of data, obviously. More Fed governor speeches, Goodspeed, Bowman, and Jefferson. So lots of data coming out on Wednesday as well. Thursday, jobless claims. Closing out the week with a lot of data as well. Non-farm payrolls, unemployment, and Michigan consumer sentiment. Additional Fed Governor Kugler speech. Lots of data on Friday as well. S&P 500 earnings, like I said, 131 companies reporting. Too many to cover in any detail here. So I'll just kind of flip through these. And any interested viewers who would like copies of this, please reach out to us. Be happy to send you a copy of the presentation. And that wraps up our investment outlook. Lots of data points, lots of macroeconomic data, lots of Trump administration activity. We expect to see a lot of headlines and a lot of debate about whether or not the impact of the tariffs are good or bad, near term, long term. And the good thing is everyone is talking about it, and hopefully the countries that are impacted by the tariffs will be talking to each other. And also at the same time, the Trump administration is trying to end the wars in the Middle East and in Russia, Ukraine. So just lots of moving pieces, lots of geopolitical and global economic activity. It's, as we said, it's probably a good time to be on the sidelines in terms of having excessive risk. We don't recommend being entirely out of the markets. There are still good pockets of growth. We've seen that activity in some of the value stocks, some action in small caps, and some of the sectors that have been lagging for the last 2 years. So it's a good time to be stock picking, rotating through sectors, but also a good time to be diversified in cash and bonds as well. So thanks for tuning in. I'm Dan Liu, Chief Investment Officer and Portfolio Manager at America First. My contact information is shown here. If you'd like to reach out, please send me an email. You can also reach out to Jim Monahan, who's our COO and resident technician, who knows a lot about the charts and very helpful in terms of helping me forecast and predict the direction of stocks and markets and sectors. So thanks for tuning in. We'll talk to you again next week, and have a great week. And if anything, it'll be very exciting to watch everything, and we'll cover it and report back next week. Thank you. Take care.